Good day and welcome to today's lesson. My name remains Big Blue, and in today's lesson I want us to talk about something that is very critical to becoming and staying profitable in the market, which is setting the right take profit level, TP101. So for today's class, we'll call our topic for today TP101, take profit before the market takes it. This is a system I put together that will guide you on how to set your take profit levels, and it will hold without having to reverse on you. So without taking much of our time, let's get right into the system. So trading is something that has to do with concepts. Okay, so for me, I try to relate everything I trade to logic. So if it is not logical, if it doesn't make sense to me, I won't trade it. So right here, there are 4 logical concepts I use for setting my take profit levels. Okay, so you frame every take profit with these 4 and you will stop getting stopped out. The first one I'm talking about is going to be structure, how to use structure to frame your take profit level. The second one is liquidity. The third one is imbalance, and the fourth one is supply and demand. These are the 4 logical concepts I use in setting my take profit levels. Now these concepts they are backed by data, and probability works in your favor when you trade using this logical concept. They are not emotional based, they are not gut feeling based. So why is take profit important? Why take profit matters as much as entry, if not more than entry? Okay, most traders give back trades that were already in healthy profit, watching price reverse and take them out. The thing is that you get in on a trade, and then you get to see that trade print some healthy profit, and then it reverses on you and takes you out. That is because you did not set the objective target for that trade. It's either you overstretched your objective target, you overextended it, and price will not get to it. It has to be objective. Okay, and again, the fix is not in slashing your risk to reward down to 1:1. A lot of people, in the quest not to overextend their take profit levels because they have been getting stopped out, they now limit their take profit levels to 1:1, risking $1 to make $1. So that is a different trap, and that is not what we want to talk about here. The market is driven by probability. Nothing is certain, of course. This market is probability based, but logic stacks the odd in your favor when you trade these concepts. When you you set your take profit levels using these concepts I'm going to discuss now. When you set your target with logical concept, you don't use fear or you don't use feeling. Let's get right into it. So the first one we're going to look is taking profit using opposing structural points. Let's talk about the concept of structure as a concept. Okay, let's talk about structure as a concept, how to take profit using the opposing structural point. So the core idea to this is you target the last opposing structural point on your entry time frame. We are going to see it in the market very soon. We are going to go to the charts, but let's quickly run through this. This means of taking profit, setting take profit level, is the easiest, it is the most common, and it is to an extent also the most efficient. Okay, it is the easiest, is the most common, and to an extent also the most efficient. It's just so easy to use with the least chance of getting stopped out. Okay, so once a valid zone is mitigated and confirmed, the last structure point becomes your first target. And to tell you how strong this is, this always holds. Most times than not, it always holds. Even when it retests your entry, it always comes back to clear that first structural point, that last structural point. Let's take a look at it in the market. Now you could see this is a bearish scenario. You could see that price mitigated a supply zone. You could see this supply zone right here. Price mitigated this supply zone. You could see my supply zone. Price mitigated the supply zone after a bullish run. Now let's mark our bullish run. You could see this is a bullish run here. We had a series of higher highs and higher lows, and then price got to the supply zone, mitigated the supply zone. Okay, so once price mitigated the supply zone, what happened? The first target becomes the last higher low before the mitigation. The first target becomes the last higher low. Now we could see the higher higher low, higher low, and then this higher high was the one that mitigated our supply zone, which is our key level, our entry point. And then our target is this low, the higher low, this low here. And what did price do? Price dumped to it. Price did not immediately clear that low. What price did is that price mitigated our supply zone, came back a little bit, mitigated it again, came back again, mitigated it again before giving us take profit. Why are we so confident that this zone will hold even though we had about 3 retests? Why are we so confident that the zone will hold? Okay, even after 3 retests, price did not reverse until it hit our objective take profit. So this kind of a trade, you take it and then you are relaxed. Okay, even when the trade seems to be going against you, you are not bothered, you are relaxed, because you know that that is an objective target and it has a high probability to give you that objective target. Most people would have come out somewhere around here. They say, oh, price has not gotten to target, but it's retracing. It retraced all the way back to entry, came back around here again. Oh, price has not gotten to target. It retraced again before finally giving you your full target. So what will give you the confidence to hold this trade to that level is because you know you are trading a logic based concept. That was the last structural point before price mitigated our key level, which in this case is our supply zone. And if that zone is actually a valid zone in line with the trend, it has to at least, at minimum, clear that last structural point. Okay, let's go forward. Now you could see this one mitigated, it didn't do any retest and it dumped. Okay, it mitigated, it didn't do any retest and it dumped. Let's see, this one mitigated, it didn't do any retest. You could see price was in the bullish run here, mitigated, dumped to take profit, which was the last structural low. Okay, the last structural low, dumped to take profit. You could clearly see the bullish move price was in on. Let me use a blue. Price was in on this bullish move, higher high, higher low. The next higher high mitigated our key level, and then what did it do? It dumped to clear this higher low. That is the first thing price will always do after mitigating a valid key level. Okay, so this one did not give us any retest at all. It just played out. So this is a bearish scenario with no retest. Let's see. Now this is a bullish scenario. Let's take a look at this bullish scenario. You could see that a downtrend of lower lows and lower highs runs into a demand level, a demand zone. You could see our demand zone here. This demand zone. This is our demand zone. It runs into a demand zone. Once price mitigates and confirms bullish, it targets the last lower high before mitigation. Now in the bearish trend, we had a series of something like this. You could say it, and then it mitigated. What is the next thing it did? It has to buy back up to clear at least this structural high, which was what it did. Okay, which was what it did, right? So we could see that immediately mitigate from this last lower high, lower low, confirmed the reversal here. The first target it has to clear is that last lower high, which is this one, and it took it out. Okay, it took it out immediately. So you could see how efficient using this strategy, using structure to set your take profit levels. You could see how efficient it is. Sometimes price might even retest the zone, retest your entry. Okay, come back all the way to your entry, but it will not take you out of the trade because it has to clear that zone. Okay, so look at this one again. This is a bullish scenario. Higher time frame contest is bullish, so we take only bullish entries. Okay, price dumped into a demand level, dumped into demand with no bearish structure. I needed to I put this here so that we can clearly look at it. It dumped into demand with no bearish structure, because I figured some people will ask me, oh, Big Lou, what if there's a case of no bearish structure or no bullish structure to mitigate our demand level? If there's no clear structure to mitigate, what if it's a dump or a rally that mitigates the level? Now look at what you do. So the target is the last higher high. Normally to take bullish trades, target is lower high. Like this example, this was the last lower high. Okay, like this example right here, this was the last lower high. This is a lower low, this is a lower high, all of that. This is a lower low, a lower high. So this was the last lower high, and in bullish examples, in bullish trades, you seek to take out the lower high that mitigated the demand level. Okay, for bullish examples. But what about a case like this? How about a case like this now, where there was no clear bearish structure that mitigated the market, but we're actually even in a bullish structure here? We could see our clear bullish structure, higher high, higher low, higher high, higher low, and then we did a higher high, and then the next thing we saw was that we've mitigated our zone. All right, we've mitigated our zone. In a case like this, the target becomes the last higher high, which is of course still the last structural point. Okay, the last higher high, which is of course the last structural point. So we'll target the last higher high. If there's a clear bearish structure that brought price down to mitigate the demand level, we would have targeted the last lower high, but now we are targeting the last higher high. Do we understand? So that is our target. So always analyze top down. Pro trend beats counter trend. All right, that's by the way. Let's go forward. So this is another bullish scenario. This was a bullish scenario. This is a bullish scenario where price did not create substructures, bearish substructure to mitigate the zone. You just mitigated and rallied back up. Okay, price dumped into demand, then rallied to take out the last structure point, which in this case was a higher high. All right, our objective target, two ways to be. If you overextend it, two ways to be wrong: overextend past valid data or cut the trade short out of fear. Now you could look at this trade is a beautiful trade. This trade is about 1:5 or thereabout. Some people will just cut the trade so short, so I don't want to hold this trade so much, let it not reverse on me, all of that. Or I don't want to overextend this, I don't want to, or some people will want to overextend this trade. and future price action might reverse this against you. So always target objective targets. So that is it for structure. We've looked at everything about using structural points to take our targets. We've looked at this: price mitigates a point, target the opposing structure point. We've seen the bearish examples, we've seen the bullish examples, and we've seen examples where price doesn't create a substructure to the zone. It mitigates maybe with a dump or with a rally. Your target is still the immediate opposing structure that mitigated your zone. All right, now let's quickly take a look at liquidity. Using liquidity to take profit using opposing liquidity. So price moves from liquidity to liquidity. Why we say that these things are logic based and they are backed with data is because price respects the logical concepts we trade. Now for liquidity, price moves from liquidity to liquidity. Above price we have the buy side liquidity, below price we have the sell side liquidity. Okay, buy side liquidity rests above price. We have buy stops and we also have stop losses of sell limit orders. For sell side liquidity, we have the sell stops and we have the stop losses of buy limit orders. Every impulse move is fueled by liquidity. Okay, price clears one side, then targets the other. So price moves from buy side liquidity to sell side liquidity. When price clears buy side liquidity, its next target is sell side liquidity. When price clears sell side liquidity, its next target is buy side liquidity. So that way you know where price is heading to, and you're able to join in that movement till it gets there. Okay, let's look at some example. But then there are two main forms of liquidity on the chart. It appears at buy side and sell side, okay, but it appears in two forms. Buy side liquidity and sell side liquidity, they appear in two forms. We have the trend liquidity, where price is trending, maybe an uptrend or a downtrend, and then we have the range liquidity, where price is ranging, equal highs and equal lows. Trend liquidity resting on the opposite side of a trend. When price reverses from a valid zone, it seeks that liquidity and carries back to the trend inception. We're going to see examples on the chart very soon. For range liquidity, we have equal highs and equal lows. Some people call it double top, double bottom. Some people call it M and W. M is double top, W is double bottom. Okay, equal high, equal low. Some people call it relatively equal highs and relatively equal lows. Whatever you want to call it, we're going to see it on the chart very soon. Okay, price consolidates, then breaks out with a sweep. The target becomes the opposing end of the range. We're going to see all of this very soon. Okay, so a bearish scenario for a trend liquidity, price targeting an opposite trend liquidity. So higher time frame bias is bearish. An uptrend ran into a valid supply zone. You could say it clearly, building higher highs and higher lows. Let's mark it. It was building what? Higher highs. Sorry, let me clear this. I need to make this a little bit bigger so I can be seeing it clearly. All right, it was building higher high, higher low, higher high, higher low, higher high, higher low, and then it mitigated the supply. Once it mitigated that supply, what did it do? It sold all the way till it took out the trend inception, because liquidity was resting all on these zones. All across these zones, liquidity was resting there. Okay, some stop losses were resting somewhere around there. Some buy stops, sell stops were resting there. A lot of things were there. So price took time, cleared everything, All right, price took time to clear everything. So if we are using opposing structural low, this last low here would have been our target, and this trade would have been a 1:2, maybe a 1:2, or a 1:3, as the case may be. But because we were using the opposing liquidity, we could see a clear trend, and because we could see a clear trend, it wasn't confusing. We believe that price we seek to clear this trend liquidity, which is that was what price did. When price mitigated this zone, it took its time, even retested our entry, but we are confident that it will not take us out of the trade. Tapped into our entry again, and then took its time and cleared the liquidity. It was until it has cleared the liquidity, going as far back as the trend inception, that it started doing some tangible form of retracement. Okay, it started doing some tangible form of retracement, which was this leg we are seeing here. Okay, but that leg is none of our business anymore. We are out of the trade. Okay, we are out of the trade. So that is how this work. Okay, so this trade did not even give drawdown. Price had to clear all that trend liquidity, almost no drawdown and no reversal until the whole trend was taken. Actually, it had some reversal. We could see the reversal here. We could see this reversal here, came back here before it cleared the liquidity there. All right, so this was a 1:11 trade using trend line. You could see the trend, you could see this trend, this whole thing. Price took it up. This is liquidity resting here, liquidity resting here. All right, so let's continue. What is this here? Let's take a look at the bullish scenario. We could see price in a bearish trend. Now I need to clarify something. The bearish trend actually originated from here. I said trend inception, because most people will tell me, Big Lou, how about this high here? This trend, this bearish trend, ended here. It ended here. Price could not reverse here to clear this high, so this new trend now started at this high. Let me explain something. You could see that price had a series of higher high, higher low, higher high, higher low, then started a new bearish trend, a clear bearish trend from this high, and then we started higher low, higher high, sorry, lower low, lower high, lower low, lower high, because this was a bearish movement. Lower low, lower high, until we mitigated, and immediately we mitigated this key level, this demand zone. The next thing price will do is to seek to clear the inception of that trend that mitigated the zone. Okay, it will seek to clear that trend right to its inception. And if you are careful and look carefully, you'll see that this was actually the inception of this downtrend, this immediate downtrend that mitigated this demand level. Okay, it's not here. This one ended somewhere here. This one is another clear trend. Okay, so it has to be clear. And this trade is a very solid trade, about 1:10 or thereabout, you could say it. So the bullish mirror, price came down in a downtrend, mitigated a valid demand zone, and reversed. From there, it sought the trend liquidity resting above and carried back toward the trend inception. I hope this is clear. It is not too difficult. Now that is for trend liquidity. But then trend liquidity is not the only liquidity. We also have liquidity resting, not just resting on trends, not just resting on trends, we also have liquidity resting on range highs and range low, which could be equal highs and equal low, double tops, double top, bottom, M's and W's. So a double top builds an equal high, the double bottom builds an equal low. The double top could be called an M because M has two equal double tops, and the double bottom could be called a W. So price drops to mitigate the valid zone after creating a double top. You could see our first high came here, creating another high. If you look at it carefully, you see that these two highs are almost on the same line, equal high. All right, so equal high, we came down here, mitigated this zone. Price is going to seek to clear the liquidity resting on that equal high, which was what price did here. You might not be seeing this around, you might not be seeing this much in the market, double top, double bottom, and all of that, but it helps you to set your target. Okay, it helps you to set your target. So the one maybe you could focus on mostly is the trend liquidity, because that one happens all the time. It's either is in an uptrend, price is ranging in an uptrend, or price is ranging in a downtrend. All right, either way, price always seek liquidity at the opposing end of a trend, also seek liquidity at the opposing end of a range. So that is that. So with that way, you can clearly target the opposing liquidity. Why do you use opposing liquidity for your target? Why target opposing liquidity? This means of setting take profit levels. It gives you a higher risk to reward. It targets trend inceptions, not just the nearest level. You know, using structural points, the first one we discussed, it targets the nearest level, but this one targets the inception. Okay, it stretches it, and you can use this for your directional bias. On the higher time frame, it tells you where price is being pulled to. On the higher time frame, let's say you mark out your trend on the daily time frame, and then you see a clear confirmation that price is targeting that daily time frame trend. If you go down to the lower time frame, you can keep taking trades until the high of that daily time frame trend is cleared. Okay, which could take a month or two. It could even give you the bias for the next 3 months. Okay, so trade only in a certain direction for a particular period of time, because you are trading to clear the liquidity. All right, so this also gives you confidence to hold your trade. You know, liquidity is still pulling price even through internal ranges, because you're going to see internal ranges. This one was the one that really did the internal range, did all these things he did here, went back up to entry and then dumped. Okay, it was the one that really did the internal range. This one did some level of internal range, came here, dropped all the way down to here before he gave us our TP. All right, before he gave us our TP. This one also did a little of that, came all the way here, dropped down all the way here before he gave us our TP. So all these things will not bother you. You know that price will ultimately hit your target. So for now, we've discussed taking profit using opposing structural points. We've discussed taking profit using opposing liquidity. Now the next one we're going to talk about is take profit using opposing imbalance open. Okay, using opposing what? Imbalance open. And without taking much of your time, let's get right into it. What is an imbalance? An imbalance is a long, strong momentum candle with no overlapping wicks before and after it, leaving an open price range where normal trading did not occur. Okay, all these things I'm trying to say, imbalance, most people call it FVG, but it's not just FVG. You need to understand that it's an imbalance, a difference in price that maybe a momentum candle pushed upside or pushed downwards. Bullish imbalance here says aggressive buying overwhelms selling. You could see aggressive buying overwhelms selling. A sharp move up leaves an open price behind. Then bearish here, what did he say? Aggressive selling overwhelms buying. A steep sudden drop with no immediate retracement. So all of this, let's take a look at it in the market. What is the system behind this? To trade this imbalance well, look at the system here. Price must react from a valid zone. So it's not random. If the zone is not valid, price likely never reaches your target. The market can reverse against you. So if you're taking a bullish trade, make sure you're trading from a valid demand zone. If you're taking a bearish trade, make sure you're trading from a valid supply zone. Okay, so target the imbalance open, the first line, not the fill. It is safer and gets hit more often. All right, you target the open of the imbalance, not the fill of the imbalance. Now we are going to go to the chart, but let me draw it. An imbalance has this line here and this line here. If you are taking a bullish trade, you should target this first line here. A bullish trade, you target this line here, the one below. If you're taking it because you are buying, so immediately price hits this line here and the imbalance is this place here. Here is your take profit. If you are selling and you're selling and price hits this top line here, that first line, you take profit. The open of the imbalance is still here, you take profit at the first line. So once price hits here, you take profit for bearish trade. Once price hits here for bullish trade, you take profit. That is what I'm trying to explain. We're going to see it on the chart. So for imbalance trade, you take profit on the same time frame. Set the target on the same time frame you entered on. Okay, you set target on the same time frame you entered on. Okay, so that you get in and get out. It is most effective that way. Then what imbalance are you targeting? You are targeting the furthest imbalance in the structure price used to approach your zone. All these things you don't need to bother yourself. I'm going to show you. So let's take a look at this example. All right, so you can see this. Price mitigated this supply level here, tapped into it. This is our imbalance here. The gap between this candle and this candle, you could see there's no imbalance here. This is an efficient price action. So this is the leg. This is how price came to us. Price came to us like this, with this leg. Okay, and mitigated here. It mitigated. Now after it mitigated, this was the leg it used. This was the structural leg. All right, after it mitigated, what did it do? It started selling, came all the way down here, ranged for a while, rallied back up. You could see, mitigated us again, and then finally gave take profit. But you will not panic. Why are you not panicky? Because you know that this imbalance has not been filled. Not just that it has not been filled, it has not even been retested. Okay, so price is not going to ignore this imbalance completely, although sometimes price action may be acting up and it will ignore it, but most times than not, price has a very strong pull coming to fill this imbalance here and then mitigates the demand level before it goes up, and which was what it did. Mitigated its demand level and then rallied back up immediately. Okay, so let's look at our notes. Reacting off supply, we target the opposing imbalance open before the demand zone. Okay, there's a demand zone below here. The first attempt fell short and returned to entry. We do not close on fear. Price filled it on the next push. Note, this was a counter trend. Okay, I think this was a counter trend trade I marked out. if you're just starting out, you should focus more on taking pro trend trade. I think the overall context for this trade was bullish, and then I took this counter to sell to that imbalance zone. But that is by the way. Let's quickly see the bullish example. Now look at the bullish scenario here. This one is very clear. So this was a demand zone. You could see this demand zone. Price came to this demand zone, very clear demand, picked order, and then rallied up. If you look closely, you will see this imbalance right here. The space between this candle and this candle is a small imbalance. This yellow line I marked there was our imbalance, so it mitigated it. A corrective move into supply. This was a corrective move into supply. Price filled the imbalance, mitigated H4 demand. I marked this on the 4 hour, so you could see that it's a very serious time. Mitigated the H4 demand and reacted up to the opposing imbalance open where we set our TP. It wicked in and reversed sharply. Okay, you could see how it mitigated us, went to mitigate that imbalance, which was what it did. Now this is a classic example of bearish to bullish, sell to buy. Some people also used to catch the buy to sell. So you sell from your supply level to your imbalance open, you buy from your demand level to your imbalance open. Okay, this is these two trades standing alone on their own. And right here, okay, this was on 4 hour, this was on 15 minutes. This is not them place, but I framed it close by when I saw that it also happened here. Okay, the full move, supply reaction, sell to fill the imbalance, mitigate demand, then buy to fill the opposing imbalance. This is not random. It is how the algorithm is programmed. So this thing you are seeing here, that somebody caught a sell and still caught a buy, is not random. It is how the algorithm that pushes the market has been programmed to operate. Okay, this is how the market operates. It's not something out of the blues. This is just how the market, you can backtest this and you'll see it. Okay, so you could see the full bearish scenario standing on its own, the bearish leg on its own. Once price mitigated supply around here, it sold to this zone. Okay, its next objective was to fill the imbalance and reach the demand level. It sold to this zone. It couldn't get to the imbalance open, came back a little bit, did all these ranges. You will not panic. Remember, this is on 4 hour. You will not panic and say, oh, this market wants to take me out. It will hit that level. It will hit that level. Now look at what the market did here. I don't know if I wrote it. Okay, let me explain it here. Look at what the market did here. When the market in the series of higher high, higher low, higher high, higher low, higher high, mitigated our supply level, when the first leg of price action that came down actually give us our first objective target, which was structural low. Remember, we talked about setting target on the structural, opposing structural level. Okay, so TP1 has delivered price around here. Imbalance open is TP2. Okay, imbalance open is TP2, which it finally gave us around here. And then we're going to discuss this other one here in the future. Just stay with me on this video. We're going to discuss why price got all the way down here and cleared this low. We're going to discuss it for our TP3. So this is your first take profit, this is your second take profit, this is your third take profit, and I'm going to explain it. All right, so that was what price did. If you look carefully, you'll see that was what price did. This is a bearish example, another one. Imbalance open, price mitigated a value supply level and dumped to the furthest imbalance on the structural leg. Price is fractal, so this works on any time frame. This one is a 15 minutes time frame, this one is on the 4 hour time frame. So price is fractal, it works across all time frames. Okay, so right now we've looked at using structure don't mind my writing. We've looked at using liquidity, and we've looked at using imbalances. These are logic-based concepts. Okay. The fourth one we want to look at now is using demand and supply for take profit levels. Take profit using opposing supply and demand level. Okay. So what is the logic behind this? Price circles between zone. Buyers always wait for the best discount at the most feasible demand level so that they can buy low and sell high. Sellers, on the other hand, are waiting for the best premium at the most feasible supply level. So the market is basically an infinite circle of buying low and selling high. 8 out of 10 times the market respects this circle. Okay, the market respects this circle. So the imbalance targets the open. If you want to trade using imbalance as your target, you target the open of the imbalance. But when you're trading supply and demand, targeting supply and demand, you target to fill the imbalance. Now this is an imbalance. This is the gap between the two candles that didn't touch. So in a bullish trade, your target is to hit this place here when you're using imbalance to do your targeting. But when you're using supply and demand level, your target now in trading this zone, in taking this trade, is to fill this imbalance and mitigate the supply level, which is after this second line. Okay, so now you're targeting the second line so that price can mitigate the supply level. In a bearish trade, you are targeting this first line if you are targeting imbalance open, but to target the opposing zone, which now is the demand zone, you are going to target to fill the imbalance and then come into this second line, okay, before you mitigate the opposing demand zone. All right, let's take a look at it in the market. So you could see this example, 2 paired from one move. First, to traders who target the imbalance open, just like I said, the people targeting the open of the imbalance are going to get paid first. They're going to hit take profit first. Then the next take profit people are people that will target to fill the imbalance, which is the opposing demand zone. In this example, you could see that price was coming from a supply level and price hits our imbalance. The first TP is structure low, it hit it. Second TP, imbalance open. TP3, demand zone. You could see how you set TP1, TP2, TP3. Okay, your first take profit level is at the imbalance, at the structural low. Second one, imbalance open. Third one, to fill the imbalance and mitigate the demand zone. So this is it. The same thing happened here. We mitigated a valid supply. We started selling, reversed back, mitigated, retested our supply, and then we dumped to fill the imbalance open. Okay, we tapped into the imbalance without filling it. So the first set of people that will take profit are people that are using imbalance as their take profit target. So they get their target and then it rallied up for some time. Remember, it rallied up for some time and then came back to give us full take profit when it filled the imbalance completely. It took about 2 hours later to fill the imbalance completely and then gave more profit. Okay, so this is the bearish scenario. Let's see if there's a bullish scenario for us here. Okay, there's a bullish scenario. Price mitigated demand and rallied to supply after filling the imbalance. Open targeters bank first, fill targeters ride further. What do I mean? That they get paid first. People that target the open, they get paid first. Then people that target the fill of it to get to the supply, they get paid later. Okay, they also get paid. Everybody gets paid. So that is that for that. So these are the 4 logical concepts you use for taking profit. You use these logical concepts for taking profit. You don't stress it, you don't stretch it. These are objective targets. Okay, your first objective target is using the opposing structural point. Second objective target is using the imbalance open. Third objective target is using the imbalance fill, which is the opposing zone, either supply or demand. Okay, the fourth objective target is using the trend inception, opposing liquidity at the inception of a trend, so it clears the full trend. So you could see how you set your take profit level 1 to level 4, okay, depending on the one that will be easiest for you. That is why I said that using opposing structural points is the easiest and most efficient, because it is the first level price must get to before it starts getting to other levels. Okay, all of them are objective targets, but in order of hierarchy, the first level it gets to is the opposing structural point. Second level it gets to is the opposing imbalance open. Okay, it gets to the imbalance open, it gets to the imbalance fill, it mitigates the what they call it, the opposing zone, and then at the end of it all, if it clears that zone, that means it clears the full trend. Okay, that full trend, that means opposing liquidity. That is that. Now let's talk about static versus dynamic risk to reward, choosing a target model that pays you, because this is where people get it confusing. The market does not care about your gut feeling. It runs on data, logic, and probability. However you trade, you must approach it the same way. You must approach the market using logic, you must approach the market using data, and you must approach the market with probability in your favor. Okay, 2 ways to set a target. People that set static risk to reward, a fixed ratio set with no regard for logic or data, needs a 50% win rate to break even. Let's assume you are trading 1:1. If you are trading a 1:1 here and you are trading a 1:3 here, now you can see this one. Now you need at least a 50% win rate to break even, risking $1 to make $1. So if you take 10 trades and win 5, you've still not made any money. Even though you just won 50%. You need above 50% win rate for any profit to be made. You need 100% win rate to be able to double your account. You need to win all your trades to be able to double your account. And it forces large risk that wrecks psychology. Now you want to make $5,000 on a trade. You have to risk $5,000 on a trade. Okay, you have to risk $5,000 on a trade to be able to make $5,000 on a trade. All right, if you lose it, you've lost minus $5,000. But imagine somebody trading $1,000 to make $3,000. You could see the difference. In dynamic risk to reward, what you do is, instead of setting fixed risk to reward, I don't preach fixed risk to reward, no matter how you want to set it, because every trade setup is unique. I think I wrote it somewhere. Did I write it somewhere? Okay, let me just explain it here. Every trade setup is unique. A setup might give you a 1:5 risk to reward. Another setup will give you a 1:4 risk to reward. So there's no need having a fixed risk to reward. What you can do is you can set a minimum risk to reward. Okay, a minimum risk to reward. That means there's a minimum risk to reward trade you can take. There are some setups you will have to forfeit that falls short of your minimum risk to reward. Okay, it filters out trades below your minimum. All right, let's say you want to trade a 1:3 risk to reward. So anything less than 1:3, you don't take it. You don't take it. And this 1:3 is not you that will force it. The trade setup will validate it. It will give you an objective target of 1:3, 1:3. Okay, it's not like you are extending your profit level beyond the objective target. All right, so even at 30% win rate, you are already profitable. Okay, so you ride each move to its objective target when you are trading a dynamic risk to reward. You catch a move that gives you 1:10, you take it. You catch a move that gives you 1:8, you take it. You catch a move that gives you 1:3, you take it. All right, a 50% win rate becomes highly profitable for you. Okay, I think I need to, I did not delete this. Let me delete it. All right, so we're rounding up. This chapter is to tell us how to make the most, extending take profit to higher time frame, to make the most out of our trades. Okay, it's called the seed to tree. Now, what is a seed to tree? You plant a seed and wait for it to mature into a tree before you harvest. So you plant low and you harvest high. When you want to plant, you bend down to plant, you dig the soil, you plant. But when you want to harvest, you have to climb up to harvest. Okay, in trading, how do you use it? Most traders cut a move short before it has realized half its potential. Then what they do is they start mourning what the market does without them. Oh, this market is still buying. Oh, I would have been on this trade though. Why did I come out and all of that? So in taking trades, we use top-down analysis, which is TDA. But in getting out of trade, using the seed to tree concept, we do down-top analysis. We enter from the lower time frame and we target higher time frame zones. Analyze top-down to build the bias. Take profit down-top to stretch the target. Enter on a lower time frame, but target a higher time frame zone using the concept we have already covered. Higher time frame zones always overpower opposing lower time frame zones. All right, so this is an example. This is a daily time. This is daily time frame on NZD USD. Okay, it reacted off. You could see that it reacted off a supply zone rather. It reacted off a supply zone, jumped down. In this case, we are using our imbalance open as our target. Okay, our imbalance open was our target. It dumped down, came back, picked order again from that same zone, retesting that zone, and then it dumped down to clear that imbalance open. And as the case may be, it could still maybe dump down to clear, to cover the imbalance completely. That is to fill the imbalance completely, but we don't know that yet. All right, so NZD daily reacted off supply, sold to an imbalance open. It took over a month, retested entry, and then continued. Taking straight off the daily, this is a 1:5 trade. On the daily, this trade is a 1:5. But when we mark our daily zone and then we want to target our opposing imbalance open, or even the opposing structural low, opposing structural point that mitigated the zone, if we mark the zone on the daily, we can go down to a lower time frame to take the trade and ride it till the higher time frame target is hit, which is what we now see here. Now this is the same trade that gave us 1:5. This is on a 3 minutes time frame. Now we cut this trade on 3 minutes time frame. You could see that it barely had any what they call it, any stop loss. Okay, the stop loss is there, but it's very tiny because it was set on the 3 minutes. But the target is very massive because the target was set on the daily. Now this trade that gave us 1:5, if you traded it on the daily and it took over a month to play, is now giving you 1:115. You made an extra 110 RR on this trade. So if you were risking $10 on this trade, you're making above $1,000 on this trade, 1,150. You risk the same $10 on this trade. What you're making here is just $50. because this is 1:5. That means you made over $1,000 extra by risking just $10. You could see how crazy this is. So this is the seed to tree concept. You plot your bias on a higher time frame. You look for lower time frame entries and ride it from the point, a valid zone, of course, to mitigate that higher time frame bias, to clear that higher time frame opposing liquidity or opposing imbalance or opposing structural level. Okay, until that is achieved. That is seed to tree, taken to full maturity. Of course, this is an extreme. This case is, of course, it's not impossible, but it takes some level of practice. So a trade that was 1:5 became a 1:115 trade. Same trade, same bias. So a refined entry on a lower time frame with the target left on the daily. So you get in on this trade, you forget about it till that target is met. Till that target is met, you make crazy money. Okay, so the seed to trade table is not here. I drew it. I don't know why it's not coming out, but let me brief us on that. It's not hard. To trade this seed to tree, there's a table for it. It's in the main book of this course. This course has a book. I'm doing this video just to explain things to people. So in the book, the tree is there, the table is there. But in the table we have, if you want to plant a seed on the M3, which is the 3 minutes time frame, or the M5, which is the 5 minutes time frame, you should seek to take your harvest on the H1, which is the 1 hour time frame, or on the H4, which is the 4 hour time frame. So this is one. You plant your seed here, plant your seed here, seek to take your harvest here or here. Either of them can work for you. All right, either of them can work for you. If you plant your seed on the M15, you should seek to take your harvest on the H1 and on the H4. All right, these are the logical ones. The example I showed us is an extreme case. This example is an extreme case. Is an extreme example, going down to the 3 minutes to take a trade and target the daily zone. It could play out, it plays out, but it's an extreme example. The most logical examples are the ones I'm showing you. You take a trade on the M15, you target the H1 level or the H4 level. Okay, it's going to yield at least ×2 of its original yield. All right, so let's look at M30. You take a trade on the M30, you should target the H4 and the H12. Sorry, not H12. Let me clean this a bit. Not H12. You could target the H4 and the H8. All right, you take a trade on the 1 hour. I'm rounding up. So you take a trade on the H1, you should target H4, H8 and H12. Okay, these are the zones you can target. All right, you take a trade on the H4, you should be targeting the daily, the D1. You can also target the weekly. All right, you can also target the weekly. I don't advise you as an intraday trader to take trades above H4. H4 is a good entry. It should be your limit for entries. Anything beyond H4, you are swinging. Okay, you want to take a trade on the daily. How do you plant a seed on the daily? So where are you going to harvest? You should be looking at harvesting on the monthly time frame, which is crazy. So you could hold this trade for a year. Okay, so it might not be worth it. Just trade the lower time frames for entry and target logical harvest points. All right, so guys, that is it. So how do you use this book? Putting the system to work. Let's round up how to use this book. Putting the system to work. Where to start? If you're a beginner or an intermediate, I would advise you take profit using opposing structural levels. That is the closest one, the opposing structural level. In a corrective move, which is a counter trend move, a retracement move, you should take profit at the closest opposing imbalance. If price is doing a correction, price moves in impulse and corrective moves. Impulse move, corrective moves, impulse move, corrective moves. The impulse moves are pro trend moves. The corrective moves are counter trend moves. So in a corrective move, you should take profit using the closest imbalance open. Okay, so when you want to trade seed to tree, entry time frame and target time frame, use it only when at least 3 correlated time frames align to one bias. I'll give you an example quickly. 3 correlated time frame. Let's say you want to take your trade on 5 minutes M5. You must make sure that M5 correlates with H1, which in turn will correlate with D1. So you see your valid zone on daily, and it's also reacting from a 1 hour zone, and then you also see it on 5 minutes. Everything aligns. 5 minutes, daily and hourly, everything aligns. In a case like this, that daily target will likely hold. So you can enter on the 5 minutes and run to that daily target. All right, in a case like this, at least have three correlated time frames aligned to one bias. That way, that concept will hold and to work in your favor. Okay, set bias from higher time frame trend liquidity, then trade lower time frames until target is met. So for bias, once you set your bias, don't trade against the higher time frame bias. You have a daily zone that price is coming from a daily supply, seeking a daily structural level or a daily imbalance open, or a daily demand, and then you want to start taking buy trades. It's not going to work. For that period of time, you should be taking only sell trades until at least the first target, which is the structural low, is met. Then the imbalance open is met. Then the demand zone is met. Okay, and the last one is price could either clear that trend and keep pushing down as become a bearish trend altogether. Clear that last this zone here, clear it and keep pushing down and all of that. Do you get? So don't try looking for buy trades from here. Don't try to reverse the market. Until price takes out this high, at least this low, comes down to this low and mitigates it, or at least takes an imbalance open on that higher time frame. So you can use this to set bias. All right, you can use it to set your bias. So I hope this has been able to impact you in one way or the other. This book, this little course material, this PDF guide and all of that is not the only, is a part of a 3-book series. I have a book on entry. I have something I'm working on entry. This might not be the last title, the final title. I'm working on it. This also might not be the final title. I'm working on a series called The Trading Made Easy. The Trading Made Easy series is going to cover your entry, it's going to cover your stop losses, and of course this one, we've already done it, it's going to cover your take profit. So it's a three-book series that covers entry, take profit, and stop losses. This one is for the take profit, which we have covered. I will get back to work and try to finalize the finishing I'm doing on this one and on this one. All right, so always check and make sure that you have the full series to yourself. It's going to help you. I wish you the very best. Do take very good care of yourself. This brings us to the end of this session. I remain yours truly, Big Lou, and do not hesitate to reach out with your questions and we will look at it together. Do take very good care of yourself. I wish you a profitable trading future. Bye bye.